Okay, investors, we're nearing Christmas, other religious holidays, and year-end. It's the time of the year when many people and investors make lists. They make naughty and nice lists, New Year's resolution lists, top college football teams, top sports plays to watch from 2024 lists, and top books to read lists. Investors, as our team has said for quite some time, cyclically, since the October lows in 2022 and again in 2023, we're in a bull market for U.S. equity assets as defined by the S&P 500. A few months back, pre-2024 presidential election, we shot a video where I postulated that the S&P 500 could get to an optimistic 7,000 by the year-end 2025 as a stretch goal. That'd be a continuation of the bull markets in 2025, with the year in the markets and economy mirroring 2017 Trump 1.0. However, for now, my model gives 6660 as a likely high point for the markets in the coming year. I don't like the revised targets because the model I run doesn't move around that much, even way out in the future. With the holidays here, I'm making my own list for Oak Harvest and my followers. It's a checklist of how things looked in 2016, 2017, and how they look into year-end 2024, and what's needed for the bull to remain alive and even thrive in 25. I'm not ranking these in order of importance right now, but you might be able to guess where our team would go based on previous videos and our commentary. So starting the list, the Federal Reserve in 2016 and 2017, the Federal Reserve raised interest rates at the short end they control. Today, they're in a rate cutting cycle which is biased to continue in 2025. Let's look at nominal interest rates as defined by the 10-year market interest rate. In 2016, they were lower into midsummer and rose by about 1.25% into year-end post-election, where they stayed stable to lower in 2017. Year-to-date in 2024, the 10-year interest rate has been lower into the midsummer and has risen about 1% off their lows. Many strategists on TV say interest rates will go up in 2025 due to deficits and tax cuts. We have to disagree. Okay, next on the list, investors, inflation expectations. They were range-bound in 2016 to around 1.25% to 1.75% and slightly higher in 2017. 2024 year-to-date, real-time inflation expectations have been around 2 to 2.4%. Real growth has range-bound in 2016 and 17, even with the proposed tax cuts for 2017. Year-to-date, real rates are around 1.5% to 2.25%, and that number looks to be heading lower, not higher, next year. The dollar was range-bound in 2016 and had a strengthening move into year-end post-election in its normal seasonal strong time period, when most everyone in the world wants to own dollars. It then went on a weakening trend in 2017 as our economy grew faster than almost every other country in the world, but it went down. This year, 2024, what's the dollar been doing? Near the exact same moves. Weaker in the first half, stronger since the summer into year-end 2025. Time will tell, but this is a high on my list of indicators to watch for next year in 2025. Donald Trump wants a lower dollar for a stronger trade position for the U.S. Take a look at the overlay of the DXY then and now. A weaker dollar would help S&P 500 earnings, as a stronger dollar has held back many multinationals' earnings this year. Think of the likes of Pepsi and Coke, or even Nike, McDonald's, or Starbucks, with large percentages of their business done outside the USA. Moving on to volatility measures. Most people I talk to recall Donald Trump 1.0 as being super volatile due to his late night or late afternoon tweets when only the American markets were open, which caused short-term volatility. This is not reality. The first year of Trump's presidency was the calmest market and the lowest volatility year ever. Stock volatility, bond volatility, almost every asset class I can think of had lower volatility, not higher, in 2017. That was great for investors, but bad for traders who thrive on volatility. On the policy front, there were taxes, tariffs, and China that were front of mind throughout 2017. Each one of those turned out to be a non-event for the most part and mostly positive. In fact, as far as the best performing asset class in 2017, Chinese equities were it in 2017. At the exact same time that Donald Trump was talking tariffs and trade crackdowns. Looking at China, let's take a look at Alibaba, ticker BABA, as the poster child for Chinese equities. Take a look at the overlay of BABA in 2016 and 17 with 2024 year-to-date. Sideways for most of the year in 2016 with a huge September-October rally, only to give it up in the last 4 weeks of the year in 2016. Then what happened in 2017 to BABA's stock? It more than doubled. it gained $100 in less than 12 months from about $86, $88 to over $180 a share. What's Baba's stock done in 2024? Near the exact same thing as 2016. Next to nothing for 9 months, then a massive 55% plus rally into early October, but now right back down to where it started from, $84 to $88 a share. Will 2025 repeat the 2017 rally in equities for China? I don't know, but China does plan on stimulating their economy. It's high on the checklist to watch. But Chris, there's chaos in the Middle East. Won't that hurt stocks in 2025? I've heard that call. Investors, can you find me a year that there hasn't been chaos in the Middle East? I had to Google it, and the answer I got back was it was 1977 was the last peaceful year of no conflict in that area of the world. I recall fewer conflicts under Donald Trump 1.0 than in the last 4 years. If I'm wrong, I will correct myself. Please send me the data so I can share it. And investors, I end my list on what drives stocks over time: earnings and marginal return on capital. In 2016, S&P 500 earnings grew about 9.25% off a down year in 2015. The S&P 500 earnings grew 16.25%-ish in 2017. In a world of deja vu, S&P 500 earnings are looking to grow between 9 and 10% in 2024, according to FactSet data, nearly the same rate as 2016. I'll drop a link to their great work on earnings in the description for you to check it out yourself. Investors, in 2017, earnings grew around 16.21%. Current analyst estimates for 2025 have earnings per share up a little over 14% to $275 a share. A little short of what they grew in 2017 into the Trump tax plan and tariffs. 14% earnings growth in 2025 to $275 a share, that would certainly be a good thing. Investors, until proven otherwise, trade or invest similarly to Trump 1.0 for at least the early stages of Trump 2.0. Why? Because largely it's the same people doing the same things and therefore expect the same outcomes. A similar outcome in 2017 for 2025 would be S&P 500 7,000. Here's a checklist to keep an eye on throughout the first half of the year, comparing Trump 1.0 to Trump 2.0. My current model comes up short of the lofty number, but as I pointed out last week, it's a possibility. It takes long-term nominal rates getting to near or below 4% by year-end 2025 for a return to historically low volatility like 2017. And while I admit those are aggressive numbers, as we first discussed months ago, they're not out of the realm of probabilities and possibilities for 2025, given the stable job markets, low unemployment, lower interest rates, stable lower taxes for 2026, and a low supply of sellers and stocks who look to push out tax events into 2026. Investors, it remains a bull market, and unless you've been a perma-bear like so many on TV networks, that remains a good thing going into the holidays and into the first half of 2025. For myself, from Eric behind the camera and the whole team here at Oak Harvest, have a blessed weekend.